Welcome to the Commodity Corner Plus podcast. My name is Mo Agostino, Chief Commodity Strategist with Farms.com Risk Management. And this week's title is this the start, a repeat of 2022 or worse? Let's get into our presentation with the summary of the weekly market quotes. And you can see from the chart, there's a lot of yellow and greens on there thanks to higher crude oil prices and fund buying. But we had a really good week in corn. It closed at new contract highs. So did oats. I think oats is following corn instead of the other way around. Soybeans, not a new contract high, but closed very well within 2 cents of a new contract high. Meal, new contract highs. Livestock producers, we've been telling you, warning you about this rally. Soybean oil, new contract highs. It looks exhausting and tiring this week, but it depends on what crude does next 2 weeks. Canola, also a new contract high. Chicago wheat came shy of that new contract high, but Kansas City did. So did Minneapolis, came shy of that contract high. Cotton had a good week, although nothing special. The livestock were lower. When you have high crude oil prices or higher crude oil prices, it tends to impact meat demand the most. And so I'm not surprised that we're taking some premium off the table. Dow Jones, I highlighted the Dow Jones, S&P, and NASDAQ simply because we are testing the 200-day moving average. We are about to break lower. I'll be honest with you. This war needs to end. We need to know more about U.S. interest rates. Fourth quarter GDP came in lower than expected. So I think we're on the verge of correcting. A correction in the stock market would be about 10%. Bitcoin is acting better, almost creating a saucer-type bottom. Crude oil, obviously up big this week. New contract highs. Closing contract highs for the week is very bullish. And then gold and silver I highlighted because they're not acting very well. When we called that parabolic top at the top, that was the top for now. We haven't traded new lows, but maybe. It almost looks like we're forming a new lower range. U.S. dollar index is soaring. The demand for that safe haven global reserve currency all of a sudden is in full swing because of the war in Iran. It's causing the Canadian dollar to plummet. That should be down. 0.08, that should be red. And then the euro dollar is also down hard. That should be red as well. New closing contract lows. All right, let's get into and we'll start off with the fact that the IEA in the U.S. approved 400 million barrels of strategic oil to be released from reserves. Look, 172 million of that was the U.S. I think the Trump administration, the EIA, the Globe, other countries are trying to calm markets down after Sunday's surge to 119 and change. Policy's not going to change this. You need to open that strait. The only way you're going to do it is with military action. I think the U.S. has underestimated this war, underestimated the Revolutionary Guards. I think they need military troops on the ground to win this. We will see. And so this is just a chart showing you number of reserves. There was news out today that Saudi Arabia was lowering their production by 2 million metric tons down to 8. The big oil producers, Saudis, don't have any spare capacity. So once you take out this 400 million, you drop spare capacity down hard in a lot of those EIA countries. There's about 32 of them. This is a Bloomberg economics chart that shows probability crude oil, the longer the Strait of Hormuz stays closed, I think they're being conservative, to be honest with you. If we break above 121, you go to 165. You break 165, you go to 200. And anybody for 250, this is your worst crisis in oil in the last century. It's worse than the 1970s Arab embargo of oil. I think it's just a matter of time, but this thing's heading higher. Unless Trump and team can prove to us that he can reopen that strait, it's going to be tough. Nobody's taken up on their offer this week when we saw 3 oil tankers in the middle of the strait on fire. It's a problem. This is why our title says, could this be a repeat of 2022? In 2021, the funds went long over 800,000 plus contracts. So this chart does not include canola, but this one does. You can, when I flip over, it almost doesn't change much, but you can see here, and let me just circle it. So that this here is 2026. And then if I move to the next chart, this one includes canola. So it's similar charts. Anyways, they're massively long. We'll get into that latest CFTC report at the end. But corn is now, funds are long over 200,000 contracts of corn. Wow. And I believe in real time, the funds are probably record long soybeans. And I'll tell you why you need to stay on the offense at the end. This is crude oil. You can see the last few times that we've been above 120. It's rare, and it never ends well. And this is the drop in 2020. But there's a support at 84.23. We closed above that. That means we could be headed back to that 121 ceiling. You break that weekly, you go to 165. So how are you going to manage the risk? Here's urea, fertilizer, a third of all urea transports through that Strait of Hormuz. We're up 203% since the April lows. This is the latest chart, and you can see the rally here in the last week. And you can see the 2022 highs. And we've explained this before. It's not really about higher fertilizer prices, although they are higher, but it's the ratio. You're using more dollars, spending more dollars of fertilizer to create a bushel of corn. And it's really just because corn prices are lower than 2022. But could we get back to those days? Here's your Strait of Hormuz, 30% of global oil trade through this choke point, 20% of LNG, as well as fertilizer, about a third. And so if you want to calm down crude oil prices, we need to open at that strait. This is the inflation. This is a chart showing soybeans versus CPI versus gasoline. Here's the start of this rally. Inflation's not an issue yet, but the funds, I think, are buying these ag commodities as a hedge against inflation. Wars and higher energy are very bullish grains and very bullish hard assets like metals and silver and so on and so forth. So the fact that gold and silver are not acting very well tells me that maybe we've priced a lot of it in. But the ags remain undervalued compared to other commodities. This is your Bloomberg Commodity Index, up 19.4% in red. The black is the Bloomberg Ag Commodity, up 4.9% year to date. So again, the 19.4 is largely because of crude oil and other commodities, but the grain ag commodity index is just barely coming off of very low lows. Don't forget about our program. Try it to scan the QR code. We were talking about what to do with fertilizer and diesel fuel needs. If you're confused, if you have no clue what to do, if you didn't book fertilizer and you didn't book diesel fuel, we can help you out. So try the program. And our members were all booked on diesel fuel and fertilizers. So if you're a member, thank you for joining. If you're not, try the program. We were booking diesel fuel last year, both for harvest and for long-term needs. And fertilizer, we had a lot of our fertilizer already booked before this war even started. USDA crop report for March was a dud. Ending stocks pretty well in line with expectations. No change there. I think the USDA was kicking the can down the road to the more important market-moving March planting intentions report at the end of the month, as well as the quarterly grain stocks report. CPI in the U.S. came in at 2.4%. Not a surprise, as expected, but this was before the war started. So in the coming months, look for inflation to go back up. In that chart that I showed you about 2022 inflation, it went as high as 9.1% in 22. We don't expect a 9.1, but I would not be surprised to see 3.5, 4.5 in the first half if the war continues. So here's headline news where Trump is trying to calm markets down. He's suggesting that he's removing some sanctions on Russian oil that are stuck on tankers for 30 days so countries can resume buying from Russia if they need that crude oil. But again, you need to open that strait. These are small moves, policy moves that I don't think will matter. China releases fertilizer reserves as Hormuz crisis deepens. One of the reasons why we booked our fertilizer was because in December, China said that they were not. The number one global fertilizer exporter was basically going to restrict phosphates. 80% of their fertilizers is phosphates, 20% urea. They were going to ban any exports from February to August. So obviously they're trying to come to the rescue for the global farmer, which is a short-term win. Cargill halts Brazil soybean shipments to China due to inspection changes. They're looking for higher requirements on inspections of weed and pests. This is just in time for the Trump Z meeting at the end of the month. This is bullish. I know that China still hasn't bought that 8 million metric tons that Trump suggested they would buy on top of the 12. But that could still happen here as we await that meeting. And over the next 15 days, those dark orange brown areas are going to get less than half an inch of moisture. It's already dry. That's not what we want. It was one of the driest winters on record in 134 years. Again, we've talked about this. It's a concern, but it's early. And the first start of April through April 15th looks cool and dry. This dryness here, after you get to mid-April, is expected to move into the Midwest. But for now, April looks dry. No April showers for May flowers. CFTC report, funds are now long 193,000. I would not be surprised if they're long over 200,000. Remember, the funds can go really long corn. You're talking 400,000 to 500,000. Beans, they are, I believe, as I said earlier, in real time, record long soybeans. The old record's 232,000. They're not yet flat wheat, but after this week's move, I think they are. Cotton, we've been covering that short position slowly, so I don't think they're long yet or flat, but you got a lot of green on the screen. And if the funds continue to buy, we're getting close to that 2021 high, but I think you can remain on the offense for the next 30 to 60 days. Just a quick reminder, the most valuable asset you own isn't money. It's really time. But because 2026 is all about headline news, particularly from Trump and his posts on social media, Try to ignore the noise. If you cannot ignore that noise or get past it, you're going to make some poor decisions. So mental clarity is wealth. And then finally, I believe this is a company called Gold Rush. It's not the title of this chart. I'm calling it the gold rush in the grain market. So you can see the double bottom here, the highs here from 22. Could this be the start of a multi-year? I don't know if it's going to be multi-year. Obviously, if you add a severe drought, you could. But what about if crude goes to where I think it can go without reopening the strait, and that's your risk. The risk is to the upside. I still think the risk is to the upside in these grains as well. But you could see a repeat of 22 very quickly. Don't forget, it's only March 13th. You got April, May, June. If you throw in a drought, you could even extend that rally into July, August. So you get this thing moving very quickly, and you're going to see some prices that you didn't expect to happen in 2026. Thanks for joining me. I appreciate it. It's been a pleasure. Until next time, thank you for watching. Don't forget to subscribe to the channel. Take care.